We should have that rate announcement any moment now. What are you expecting? Are you expecting a rate cut or consensus? Nothing.
We lean towards a pause. But like you said in your opening remarks, even if one were to happen, it's probably the end of the rate cutting cycle for now. From our perspective, we think RBI's actions on maintaining a surplus liquidity situation in the market is probably more important to figure out, how you get that transmission again, like you said. But we don't think even if they do a rate cut now that you have another one left in the kitty. But liquidity measures, and I'd make a point that look, if the pressure on the currency were to abate, and that is where perhaps the trade deal might be conducive. If the pressure on the rupee were to abate, then the ability of the RBI to drive liquidity surpluses actually improves materially. Yeah. So there is reason to be hopeful, but we'll see how the.
In fact, that was the next question I wanted to ask you, saying that given the announcement of the US-India trade deal, and though the details are still pending, broadly that's been beneficial for the rupee in terms of strengthening. We're at about 90 levels now. Do you expect transmission to get easier for the central bank from here on, and to what extent?
Well, again, as I've said in my internal communications as well, that what the US deal does so far is to help improve the confidence.
Sanjay, I'll interrupt you for just a second. We just have news coming in. The central bank has held the repo rate or the key rate at 5.25%, so the consensus has prevailed. Sure, please go on. Let's talk about transmission.
Yes. So look, our expectation is that there was a bit of a negative circularity in the currency markets as well. There was an inbuilt expectation that the rupee might continue to depreciate, and people were acting accordingly. So once you've got the trade deal, while it may not necessarily change my GDP growth outlook in the next 12 months, it may not necessarily change my earnings estimates from the, let's say, equity market as well, but it is a booster of confidence, and therefore in the near term, it might be easier on the currency pressures that we've seen with the central bank grappling with, right? If you ask me the next question, and look, I think flows will come back to India? I have a mixed view there as well. But yes, if the pressure on the rupee were easier, then driving liquidity in India, that becomes that much more convenient for the RBI.
It shows confidence, Sanjay. I'm just wondering whether it's also keeping its powder dry just in case.
Yes, and I think that is advisable as well, Haslinda. Look, if you think about the external environment, there's a lot of uncertainty whether the global growth will sustain at its robust momentum today, what kind of volatility you might see, what kind of geopolitical surprises might pop up in the next few quarters. We don't know. So both fiscally and from a monetary policy, it is perhaps advisable to keep some bullets in check, right? Not stimulate right now, but defend an ability to stimulate if something were to go wrong, let's say in the next few quarters.
How are you positioning on the back of the confidence you're seeing right now? Because we have a trade deal which has been in the making for the last 6 months. We've been waiting for that, and it finally happened, that agreement, first phase or not. And now we have an RBI that's pretty confident too. Does that shape in any way the way you mobilize your capital?
Well, look, I'd say that India has decent growth outlooks, whether it is in a real term, nominal GDP, 9 to 10% is also fairly decent. From an equity market point of view, I think earnings for the next 12 months should be of the order of 12 to 13%. It's a respectable growth. The challenge we're facing at the moment is that we're competing for attention with far more exciting opportunities perhaps in North Asia. The tech cycle is very robust. The memory cycle is on an upswing at the moment. So it is logical that a fund manager globally finds better use of his time outside of India at the moment, right? But India in itself, in an absolute basis, is now trading at much better relative valuations. I mean, I have now the Indian PE premium to EM has actually come off quite a bit. There are markets now which are trading higher headline PEs to India in North Asia at the moment. So interestingly, India is at a situation where the index is now looking relatively fairly valued. We have about 10 to 12% earnings growth. So I keep arguing that, look, for an individual based in India, the equity market is still a better return, especially on a post-tax basis. It's just not that high growth that we had seen for the 2 years post-COVID. So if you get your expectations right, if you're comfortable with, let's say, 12% CAGR for the 13% CAGR for the next 3 years, then equity still makes sense.
So you're suggesting that the outflows we've seen, through the course of last year at a record, almost $18-19 billion. This year, we're already $3 billion in outflows. That will persist as a trend through the year?
Well, it's very difficult to call a turn in flows in the very short term.
Sure.
But like I said, if it's a relative trade and I can see better opportunity, better dollar returns in other markets, it will be difficult for India to pull flows in at the moment. Now, that's it's a known unknown. We don't know when the AI sentiment will turn. Is it now? Is the tech, excitement already abating, or will it rebound? These things are extremely difficult to anticipate. But I would argue that getting FPI flow in at the moment still requires a lot more effort.
All right. You made a reference to, other markets looking more exciting, other opportunities looking more exciting. One of the events this week, and what a mad week it's been, right? We've had the budget, the India-US trade deal. We've had the software sell-off that's hurt India as well, and then today's monetary policy. That software sell-off, Sanjay, I'd like your comments on. How much of a drag is that going to be, not just on the benchmark indices, but across the board? Last year, IT was, I think, the biggest drag on the Nifty 50. Do you expect that will continue through the year as we see more news flow around AI?
So it's a very complicated situation, Menika, because it is a very real threat, not just to the IT space, but to overall economic activity as well, because IT is a major part of job creation in India, especially for young graduates. There are many roll-on effects or knock-on effects to the economy as well. So if you see IT under pressure or IT job or net numbers start to reduce, then you would worry not just about the IT sector, but perhaps for real estate, for consumption in general, and Indian economic growth as well. Right? And this is a question that we cannot answer today, because we know it's a scenario that can play out. As of now, it's not played out yet. So if we look at, let's say, ancillary data points, which is the rentals for commercial property or the utilization of REITs, for example, or the net hiring in the services sector, it still looks to be fairly decent and positive, right? Now, IT companies may not be hiring, but the GCCs are still hiring. So as a service sector, we're still okay. Is this a threat? The answer is yes. Can I dismiss it? No. So until it gets resolved through evidence over the next 2 to 3 years, I think it will remain a constant worry for people looking at the IT sector in India.
Sanjay, people talk about how software companies will not be decimated. In fact, they will instill AI in their processes right now. What's the outlook for Indian AI companies? At what stage would you be a buyer?
The last bit is very difficult to answer, Haslinda. I think we'll have to see how the situation evolves. But the way I see Indian IT companies adapting to AI is to try to become implementers of AI projects, right? And this is how IT companies have historically, worked around disruptions in the service industry. Whether it was the role of cloud computing or digitization, etc., they ended up as net beneficiaries because they got a lot of implementation projects. Is that the way AI implementation will roll out as well? Will Indian companies on net get more work on global demand for AI implementation? We don't know. We'll figure out. There is a scenario, Haslinda, where actually you don't need that much manpower to implement many of these projects. So I don't think that there is a price at which we can start advocating IT companies, but we will need to monitor these developments. And if I can make a case that the business is secured for the next 3-5 years, then I get a little bit more confident about the IT outlook.
Sanjay, I want to talk about the budget as well. In our conversation with the government, they did talk about how they're expecting the trade deal between the US and India to boost growth. I mean, given that projection, how best to play this as an investor?
Well, it is very positive. And look, in combination with the India-EU FTA, if I were, let's say, a textile manufacturing company in India, I now have significant advantage in exporting globally. Whereas historically, Indian tariffs were hurting our exports. Now our tariffs are lower than peers in South Asia and Southeast Asia as well. So if for a period of the next 3 to 5 years, if the tariffs stay as they are globally, then Indian smaller industries such as textiles, footwear, the labor-intensive exporting, let's say auto anchs, should be able to gain market share in an export environment, right? And so if you're looking for businesses where there is a material EPS impact, where there is growth outlook which has changed on the back of the deals, the EU deal and the US deal, then you'll have to go really small and mid-cap manufacturing sector sort of stocks. But the problem, Haslinda, is if I then look at the Nifty 50 and the large cap, banks, IT, consumer, the deals nor the budget has any implication for my 12-month forward EPS, right? And if we were projecting 12% before or last week, we still be projecting 12% now. So from a large cap investment perspective, like I said, it boosts confidence in a 3-5 year economic outlook, but doesn't change my EPS for the near term. Whereas if you want to play the trade deals, you have to go really mid and small caps in terms of picking stocks.
Yeah, fair enough. I have a two-part last question, at least on my end, Sanjay, and that is one, there are sectors outside of IT that do look interesting. So much news flow in banking, both in terms of new investments, but policy changes. Auto has been a shining sector, at least in the last year or so. What looks most appetizing to you? That's one. And the second one is a slightly longer term one, which is that do you see big shifts or big challenges to the competitiveness of Indian industry and its profitability because we have opened ourselves up to trade quite significantly in just the past few months, right? We have the UK deal, the EU deal, hopefully we'll get details on the US deal, and then of course the smaller ones, New Zealand, Oman. So the medium term outlook on how you see businesses sort of faring in this open trade environment?
That's a very interesting question. But let me answer the easy part first.
Yeah,
what looks interesting now? So the two segments of the economy where we see business momentum improving, right, and which is where I think companies could therefore surprise, would be financials, where with a supportive regulator, at least the regulator intends to drive credit growth and liquidity in the system, financials outcomes should improve. We've written research arguing that the large banks in India should be able to deliver 13 to 14% EPS CAGR for the next 3 years.
Right.
And given the multiples, that's a great trade-off for me. I'd really continue to like the financials. The other segment where I think operations or business momentum is improving is the consumer pack. Now the challenge with autos is something that you've talked about, but we think consumption in itself is finding its feet. Urban consumption, discretionary consumption is starting to look better. The challenge here is that companies are facing intense competition. So even though the consumer is feeling better because inflation is down, because the GST was cut, taxes were cut, and there is an improved disposable income outcome, but you will not see this translate to bottom line for every consumer company because the competitive intensity
already is the trend.
That's right.
Yeah,
so we have to have a combination of the top-down view that the consumption sector is looking better and a bottom-up view of figuring out, okay, which company has fewer competitive issues, which company is able to maintain its margins better, and then bottom-up pick the ones, and you end up largely with the autos for now at the moment.
Right.
The second part of your question.
Yes, Sanjay, thank you so much for that.
The second part of your question. Sure.
Go ahead, Sanjay.
Yeah, the second part of your question, Menka. I think, look, India has opened up, but the challenge that foreign companies might face in India when selling stuff in India is that the kind of product that Indians consume because of the reduced per capita income is not necessarily the kind of product that is manufactured in these developed economies, apart from, let's say, commodity staples, food, dairy and stuff. But the kind of cars sold in or manufactured in a developed economy are not the cars that we will buy here. So they will have to adapt products to local taste. And that takes a while. And that takes decision making, right? Do you want to create capacity to cater to an Indian requirement, an Indian taste, especially if you want to gain volumes? If you want to just sell what you are currently manufacturing, you have a small clientele in India. Right. So am I worried that a lot of my auto sales will be disrupted because European cars will come to India?
Not at these price points.
Because those cars have a small footprint of demand in the Indian market. But are they able to design products which Indians will buy? We'll see.